Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is July 1st, 2021, and we wanted to start off by wishing every one of our viewers a happy, safe, and fun July 4th long weekend. We all deserve it after the last 15 months or so. And secondly, what I also wanted to do was apologize to everyone because we missed last week's market update. I was feeling a little bit under the weather, but we'll make up for it this week, I promise you. So let's go ahead and get started. So in terms of this week's market update, it's really about getting back to basics. It's about looking throughout the stock market and the US economy and understanding what are those areas of the market that are what we call castaways, where for many, many years, they've been unloved, they've been underowned, and where underneath the surface, there's a certain level of volume, or not volume, but value that's building up. And that's what really leads to long-term opportunity. Back in 2016, 2017, when we started this firm, technology was that area. Healthcare was that area. Certain areas of the consumer discretionary sector were that area. And we were able to identify companies leading the charge. And that led to, in 2019, industry-leading rates of return of 41.2%, last year being up 101.2%. And the key this year, being able to generate that long-term performance is to make a series of hard decisions to reposition the portfolio for what's going to generate performance, not over the next month, but over the next year, 3 years, 5 years. And so what we've done is sort of like an aircraft carrier. We turned the aircraft carrier around, rotated away from those high multiple areas of danger, as we call it. So those high multiple technology and clean energy stocks that have certainly generated a lot of return over the past few years, but are now really in the final throes of what we call irrational exuberance. Does that mean they can't go up for another week or two, or maybe another month? Of course not. They can continue that. In fact, many people who saved a lot of money in 1999 ended up selling technology in the back half of 99 only to watch technology rip higher. That's not our focus. Our focus is to look out over the next 5 years and understand how can we build and sustain industry-leading rates of return while also managing risk and also making sure that we preserve client capital. And so the key right now for us is to rotate out of those areas and stay focused on those areas of economic sensitivity, which are energy, industrials, financials, and select areas within the consumer space as the US economy powers up, broadens out. So that's sustaining the US economic recovery as more areas and people are brought along that rising tide. That's our focus. And what we see here this week is 3 key messages. We want to stay focused on economically sensitive stocks that are going to benefit from higher nominal growth. 2, we see that recovery is gathering momentum and broadening out. 3rd, high multiple technology and clean energy stocks are the key areas of risk. Those are the areas, ladies and gentlemen, we want to avoid. Now, in terms of the overall market, based on our homework, in terms of the reflation trade beating the global financial crisis back in 2008, 2009, where there was record low stock ownership across the US investor base, that was the birth of a new 20-year secular bull market. And so based on our work, our historical work, our fundamental work, our technical and quant work, what we see here is we're really in the middle innings of that 20-year secular bull market. It was interrupted by COVID the same way the 1982 to 2000 bull market was interrupted by the 1987 crash. That's the same kind of structure that we're in right now. So we think we have many, many years ahead of us in this secular bull market, which is great. And then, of course, the chart on the right here shows that we should never be intimidated by strong first half stock market performance. From a historical standpoint, when we look at these numbers down here, when we have strong first half performance in the stock market, the historical rates of return for the second half are above average. In other words, strength begets strength. That's a key message we want to keep in our heads here. Overall, too, the stock market's acting very orderly, organized, and the way a bull market should act. We're bouncing off these 50-day moving averages here over the very short term and then resuming to new highs. What we see here is very strong trend. The percentage of stocks above the 200-day moving average, north of 90%. Don't fight the trend. Now we have a little bit of short-term weakness in terms of the percentage of stocks above the 50-day moving average. And a lot of that was caused by the pullback in energy and industrials and consumer discretionary stocks. That's starting to swing higher again. And that's, again, very emblematic of a bull market. We get the percentage of stocks above the 50-day moving average that pull back. That's where we see back into this 50-day moving average here on this chart on the left. But the overall trend remains strong, and that's the key. Credit markets look great as usual, ladies and gentlemen. Credit risk premiums dropping across the board. We even see, again, the VIX remains elevated. Volatility remains elevated relative to the credit markets. VIX tends to trail the credit markets. So if VIX comes down, guess what that means for asset prices? Asset prices go up. Remember, we talked about how volatility is a future implied asset for investors. We want to embrace volatility. We like volatility so long as volatility comes down after we buy that highly volatile asset. In terms of the labor market, we talked about how the US economic recovery is broadening out and gaining steam. Look at this. Overall, US jobless claims have fallen to cycle lows. In fact, this was the 388 estimate. We actually came in at 365 this morning. Then look at the job openings, absolutely exploding higher. The quits rate is going up. The job openings are going up. Again, this is not something that happens ahead of a recession. And of course, it's leading to optimism. Not a huge fan of looking at consumer confidence because it tends to be a coincidental indicator, not a forward-looking indicator, but nevertheless backs up the theory of what's taking place with some of those forward-looking indicators in the US labor market. And then, of course, inventories remain lean. We want lean inventories because the way recessions start is either through a credit recession, in other words, banks and bad loans cause a credit contraction, or through a plain vanilla recession where businesses get too bullish, they buy too much stuff in their inventory and they can't sell it through. When you have lean inventories, and we've all experienced that if we've gone shopping for a car, a house, random goods across the retail space, when there's no inventories, companies have to reorder those, and the supply chain is what drives the global economy. So inventories are low, takes a small amount of demand to continue that growth going forward, new orders, et cetera. And what we saw with the ISM data this morning was that new orders, again, continue to accelerate higher to those post-recession highs. And we see in the credit card spending data as well. Look at this, 17.9% rates of growth when we look at a 2-year cycle. And the change from pre-COVID levels is now above where we were prior to COVID. So we have a very strong consumer, high savings rates, incomes are growing. In other words, that recession didn't really impact the US consumer. It made the US consumer better, which is very odd for a recession. But that was the whole idea of the government stimulus checks that came through over the last few months, those jobless benefits, et cetera. Now, we want to pivot a little bit here real quick to portfolio design. Now, we've made a lot of big shifts in the portfolio. And so the way we've been explaining this to clients 101 and advisors 101 is to look at these two charts. Now, we want to encourage clients to look at these two charts and say, which chart do you think represents significant downside risk if you were to buy it today? And which chart represents upside? Remember, these are 10-year charts. Now, most people are going to say, well, this chart on the left looks very overbought, parabolic. Why would I buy anything up at these levels? Versus this chart hasn't done anything for 10 years. Maybe that's where the value is. And you could not be more correct. This is technology on the left. So let's take a step back, and when we are itching to buy those technology stocks, remember this chart. We are parabolic right now. It reminds us a lot of those 2000 levels. When we look at energy, which is the chart on the right, unloved, under-owned, and the fundamentals are improving. Just look at oil prices today. So this is where the opportunity is. This is when we think of how can we double the value of our strategy over the next 2 to 4 years. It's an energy overweight. Here, I worry about picking up pennies in front of a steamroller. So we want to be very, very careful. And we see that on the valuations as well. technology valuations north of 50 times earnings versus 14 times earnings for energy. Which would you rather buy, right? So we're posing the question to our clients and advisors. And I think in many cases, when we think of this logically, we begin to realize that energy seems like a very attractive long-term investment. Now, we know within energy, there's a lot of dominant hyperbole out there. Energy is going to be in a permanent bear market because in 5 years, we're not going to use energy anymore. Oil and gas consumption is a sin, even though we all drive cars. Most of us don't have an electric car at this point in time. And that renewable energy is about to replace oil and gas. Here's what the data-driven reality is actually telling us, right? We don't have a philosophical view on this. We just let the data drive our view. Global oil consumption is about to hit a record high, right? And for the first time ever, we're not getting a supply response because of the regulatory framework around new drilling permits and the lack of investment because oil and gas has been in a bear market over the last 5 to 7 years. So the industry has lean balance sheets, has low costs, but they haven't been investing in new oil wells. And so guess what happens as the oil price goes up? Those cash flows are going up because there's hardly any costs on the balance sheet, but they can't expand the overall amount of production. So good cash flow production, but not necessarily expanding that production to new areas. So the bar has been set very, very low to positively surprise in the energy space. And then when we think of technology, exciting doesn't mean money, right? Just because it's exciting and sexy doesn't mean we're going to make money. And that's our number one focus. How do we make money? We see here is the ARC funds, and the ARC funds are really composed of those high multiple technology, clean energy stocks, SPACs, etc. We see that here, the chart on the left in the red line versus the NASDAQ in 2000. What we see here, it is following almost tick for tick what happened with the NASDAQ. That initial high that we saw in March, which is what caused us to shift out of technology and into cheaper areas of the stock market. Counter trend rally, which we're not involved in, led to some underperformance there for us. But this is the longer term trend, and this is what concerns us. And this is where we're trying to mitigate risk. This is where we're trying to protect clients and at the same time generate return by being in the new areas of secular growth. Remember, it was all about technology in 1999. And guess what happened by the time 2002 came around? It was a commodity super cycle. That's how quickly things turn. Then we look at the combined weights of the 5 largest S&P 500 stocks, all technology: Apple, Netflix, Facebook, Google, Microsoft, 25%. So again, this is all emblematic of, really the final throes of a secular bull market within a certain sector. Then we look at software relative to energy. So we see here on this chart is the relative performance of software stocks versus energy. Despite that counter trend rally, what we're seeing is a series of lower highs. This is a great way to unmask weakness when you see prices going up. Yes, prices are going up, but underneath the surface, there are symptoms of building weakness, building disease. And what we see here is that software stocks continue to make lower highs relative to energy. The percentage of software stocks in absolute versus relative uptrends is also declining across the board since the peak in December. So yes, lots of counter trend rallies that look sexy and itch us to buy them. But the long-term picture is, again, these relative and absolute uptrends are beginning to decline. And of course, what we really love about energy is that no one owns it, ladies and gentlemen. 3.5% of the S&P 500. It used to be north of 15%. Now it's actually closer to 2.4%. We look at the 10-year track record of the XLE versus the S&P 500. S&P 500 is up over 200%. This is a chart's a little bit dated, which is why I'm padding these numbers. And energy is actually down over the same time period. So again, where's the relative upside versus downside when we look at these charts? Let the pictures tell a story. Very, very important. Does this mean it's going to play out in the next week? Of course not. But over the next couple of years, this is how we build wealth. This is how the top 1% think. This is how I'm investing my own personal money. I'm actually 100% invested in energy at the moment. Then, of course, we talk about the overall balance sheets of energy stocks. we see here is the implied credit risk over the last 10 years has rapidly improved. We had the huge disruption caused by the oil price collapse in 2015, right? We saw those credit default swaps spike higher. Then we had a relative period of calm, and then COVID. Here's the key though. COVID represented a lower shock than the oil price collapse. Remember, in COVID, oil prices went negative. So what does that tell me? That tells me that throughout this time period, balance sheets were fortified, because this, when we think of negative oil prices, should have been higher credit risk than the oil price collapse. But it wasn't, because the balance sheets have been repaired. And now as the oil prices go up, guess what's happening? We're seeing a direct response as it relates to profitability for these oil companies. They've taken all the fat out of the system, and all that revenue is dropping in the form of cash flow. That's what we want to see as investors. And then lastly, rates versus bond proxies. The 10-year yield has pulled back, but look at the staples and utilities relative to the S&P 500. Remember, these are bond proxies. So when rates go down, they should go up, but they're not going up relative to the S&P 500. This tells us that the 10-year yield may very well hit 2% before 1%. So we want to position the portfolio in those economically sensitive areas, such as energy, industrials, the banks, etc. That's how we do symptom-based investing, then targeting those areas of secular growth. So overall, the economy is broadening out, the recovery is strengthening. Energy really is positioned for long-term secular growth. It is so under-owned. I cannot think of a more attractive area to invest really over the last 5 or 6 years. This really, really does excite us. And then where we want to be careful is in those high multiple technology stocks. And overall, credit markets remain rock solid, which is good for the overall health of the stock market. Thank you again to everyone for all your business, for all your feedback. And if you have any questions, please feel free to reach out to your advisor, or you can reach us at 888-543-3776. Thank you again, and have an absolutely fantastic long weekend, and we'll speak again soon.